Hi, in this tutorial, I'll be walking you through the course Globalization and National Policy, PAD410. Before we go into details, by the end of this tutorial, you must have known what the course is all about. You must have known by yourself without the help of anybody what this course entails, what it stands for, how it's being used, what are the things that is required, and its proper application. On our list is New International Economic Order. The demand for new economic order (NIEO), especially by developed nations, can be traced to the first UN CTAD, which stands for United Nations Conference on Trade and Development in 1964. The United Nations Conference on Trade and Development is a part of United Nations Secretariat dealing with trade and investment and development issues. Now, the push for new international economic order was as a result of the dissatisfaction of less developed countries, LDCs, as they were denied access to things like trading, financing, technological and other policies pursued by developed countries. They were literally discriminated against, drained their income, discriminated and denied access to the advanced technologies. Less developed countries were really dealt with. They were not feeling the whole thing. It was just the advanced countries that was in charge of everything, and they had to clamor, they had to request, they had to begin to demand for a new economic order. So that's what that is all about. A new economic order came into play as a result of the fact that LDC, less developed country, were being marginalized by developed ones. So the objective of this new international economic order. Now, before we go into that, developed country in the sense that countries like the United States of America, France, Germany, Russia, Britain, these are the advanced countries, and they were taking advantage of less developed countries. So there was a demand. So and now the objective of this demand are international trade. International trade by the less developed country, they request for access to international trade, meaning that they want a larger appointment and a greater responsibility on international trade. They should be allowed to trade internationally. They want tech transfer, that's technology transfer. In order for their research and production to be expanded, there should be a kind of technological transfer. So interdependency and cooperation, they requested for interdependency to all depend on each other, exchange raw materials, exchange goods and services, and let's cooperate together. So we also have that as that. So with that being said, we move straight to planning as an instrument of economic development with the case study of India. Now in India, the pioneers of India, their work created was focused and keen on academic circles. Now, what that means is that the pioneers of India, their work was majorly focused on academic circles. Now, in 1938, there was a first attempt made to evolve national plan for India. Now, this national plan for India, why are Indians clamoring for that? Now, they want it because they want to grow their economy, they want modernization and self-reliance. They also want to increase national income per capital income. Per capital income means the sale of assets. Income gotten from the sale of an asset. So now they want a raise to raise agricultural production, employment opportunities, and remove poverty. So with that being said, we move to the next agenda. The next thing on our agenda, global power and wealth distribution. This came into play as a result of an attempt to examine the way in which global states manages the process of globalization and wealth distribution. Global states, as I mentioned earlier on, global states are United States, USA, Britain, France, Russia, and Germany. Now, global power and wealth distribution. This actually came into existence as a result of there are some states that are well developed and others that is definitely there. Now, how do they go about the process of distributing this wealth? Because this wealth, they are not actually an island of wealth. They got wealth from the support from other nations. Now, not for one nation not to be particularly or a monopoly, in order for a nation not to be a monopoly of the wealth, there has to be a proper distribution to other nations. Now, what are the instruments applied in distributing this wealth? So we have the multinational corporation, we have the joint venture corporation. We have the joint venture and the multinational corporation. Multinational corporation has to do with a state, one of the states using its own organization, using its own company to reach out to other states. And we have the joint ventures whereby two states come together to achieve a thing or the other. And one thing one of the instruments that they also use that's not so good, it's the cartel and the use of threat. They use this cartel and use of threat on a less developed state, a less developed country. They impose things on them. If they don't comply, then they deny them access to some things. So that's that for that. So we move straight to risk. So move straight to risk. What is risk? According to Hurricane 1999, risk is a situation of certainty about an outcome, what outcome will occur. Yeah, let me take that again. Hurricane 1999 says risk is about, it's actually a situation of uncertainty about what outcome will occur. So K also say, that's KAYE, also an angle of an event. It says that an event, like from the angle of an event where an event is likely to occur. So we have the nature. Now the nature of risk is based on chance and uncertainty. So we have types of risks. We have the internal, from the risks is divided into two, internal and external risks. So for the internal, now we have the systematic, we have the unsystematic, we have the business risk. Now since anything systematic has to do with taking actions, so whether attached risks attached to them. So that's just this. We have the systematic, we have the unsystematic. So we have the systematic and we have the unsystematic. We have the business risks, we have the liquidity risks. All this can be developed. They are actually self-explanatory. Financial risks, exchange rate, certain risks attached to the exchange rate, political risks. We have the operational risks. We have the speculative. Now, the speculative is more about the investment risks attached to investments. So, to further explain, because they are divided into two. The external risk, the financial, the systematic, financial, speculative, they're all external risk. Exchange rate risks, market risks, political risks. So now for the internal, we have the strategic risk, we have the unsystematic risk, we have the liquidity risk. Now let's take this liquidity types of risk which may arise from the fact that firm may find it difficult to generate enough quantum of funds. Liquidity has to be money, generating enough funds. Okay, operational risks attached to operation, businesses, and that's that for that. So we move to the next thing. Stakeholders risks. There are risks also applied to this. We have the employee, so we have the shareholders, we have the labor union, we have the supplier, we have the distributor, and we also have the outside stakeholder risks, which is the government. Government also interested in businesses, and the regulators. We have the media. The media always bringing out information to further foster the betterment of the organization. So we have the costs of risks. After the costs of risk, so we have the inadequate cash flow. Cash flow is not adequate, it increases the chance of risk. We have labor unrest, that's disagreement between management. So we have weak internal control, and all those are the causes of risk. So we have attitude of some people to risk. So we have the risk avatars, people that avoid risk totally. We have the risk seeker, people that are willing to pay for the average cost of risk. We have the neutral people are not willing to pay, so they pay only an average cost, but risk seeker doesn't mind, are willing to go all out and take the risk. So we have, quickly let me go to hazard. We have the physical and the moral hazard. Now the physical hazard has to do with location, construction and exposure of a business, while the moral hazard has to do with dishonesty, insanity and indifference of an employee. So that's that for that. So we have the risks to business. What are the risks to businesses? We have terrorism, we have political instability, we have piracy. Yeah, piracy is when you take somebody work and you claim it as yours, without having authority or the query from the person, claiming other person's work. That's piracy. So we have credit crunch, we have global pandemic, just like COVID-19 that happened about last year. So that's serious risks and threats to businesses. So we have that at that. So we move straight to business policy. Now the genesis of business policy can be traced to 1911 in the Harvard Business School, when the Harvard Business School introduced an integrative in management science and aimed at generating management capacity. So that's that for that. So we have policy and strategy. What are the difference between policy and strategy? We have the policy is a blueprint, while strategy is more decision making. Policy is done by top management, while strategy is done by middle management. Now, policy goes about day-to-day routine, but strategy goes about day-to-day action. So that for that, we have public analysis. What is public analysis? Now, public analysis is said to be the systematic analysis. It's said to be systematic analysis which involve the process of determining and highlighting relevant and pressing public problems and issues. I'll take that again. Public analysis can be defined as a systematic analysis which involves the process of determining and highlighting relevant and pressing public problems and issues. So that's that for that. So we have the types of public analysis. So we have type of public. Okay, we have type of okay, that's that for public analysis. We have policies now. Types of policies: we have distributive policy, we have fundamental policy. Now distributive policy is the incremental dispersal of units of different segments of the populace. Now we have fundamental policies derived from the constitution. It's fundamental, something fundamental, foundational. We have major policies done by legislative, and they enact some law. Yeah, done major policies done by legislative by enacting. So we have function policy, we have mega, we have meta policy. So we have features of policies. We have policy is based on choice, is based on projected decisions, and is also goal oriented. So we have that as that. So we have catalog of business policy. Now business policies are policies that guide and regulate the business. What are the catalogs of business policy? We have payment of business policy, we have the shipping, we have the shipping of business policy, we have the returns of business policies. So we have the types of business policies. We have the external policy and we have the internal policy. We have the appealed policy, we have the explicit now. Okay, now the external is more of the government decision on business, the internal is by the firm, the appeal is by the employee. When employees speak on what they think the policy of the company should be, because it does affect them, whether positively or negatively. whether positively or negatively. So that's that for that. That is types of policies. That's external policy, internal policy. Appealed explicit is when policy is being clearly outlined, but implicit are when they are not clearly outlined. So that's that for that. So we have characteristics of policy. The density, it has to be measurable. So it has to be intellectual, has to be an input, intellectual input of policy. It's necessary. We have consistency. Policy has to be consistent. Policy has to be continuity in policy, and it has to be balancedly interpreted. Balanced interpretation. So that the sources of policy, we have the originated source of policy, we have the appealed source of policy, we have the external source, external imposed policy. That's externally imposed maybe by the government. The appeal is more of the employee, and the originated is from the top. So we have qualities. What are the qualities of good policies? We have application, we have the definition and the purpose. The application of the policy has to be good. It has to be well defined, and the purpose has to be clearly stated. So we have business policies. Why is business policy important? Business policy is important because it helps you to understand business environment, helps you to understand the organization, helps you to learn the process, and helps you to develop yourself. What are the objective of business policy? Now the objective is to increase in knowledge, increase in skills, and improve attitude. And this brings the end of this tutorial. I believe we've learned a lot. We've glanced through the material as a whole, highlighting points. By now, I'm sure you can attempt questions. You can say a thing or two about what this course is all about. Thank you very much, and I look forward to seeing you next tutorial. Bye bye.